Okay, good afternoon. New data is in with the CPI report being released yesterday, January 12th, and I'm going to cover it, the news it brings for the market and potential Fed changes coming forward. The CPI data came in, or the Consumer Price Index, which is what we use to basically measure inflation. And it came in at 6.5% in December, which is down from 7.1% in November, and that's year-over-year numbers. So that 7.1% down to 6.5% is huge. This marks the sixth consecutive monthly decrease since the peak of 2022 when inflation was at its ridiculous, I think 9.1 or whatever it was. Yes, December, annual inflation rate was down 7.1% in November as well as below the 9.1% peak in June. So there's two ways to measure inflation. We can either use the CPI index or we can use the core CPI index. And the core CPI excludes energy and food prices because those can kind of change a lot more and they're a little bit less, they give less insight onto what is happening in the actual economy. So on the core CPI, it climbed to 5.7% in December from the previous year, which is still good news. Like I said, some economists see that the core CPI as being a better instrument in order to measure inflation, whereas CPI is Consumer Price Index, and the core CPI is Consumer Price Index minus energy. The core prices increased at a rate of 3.1% for the past 3 months that ended in December in the slowest pace in more than a year. On a monthly basis, the CPI fell by 0.1% in December due to sharply falling energy prices and slowed food price increases. I'm going to hop into the charts a little bit later on in the video and show a little bit more detailed breakdown of what sectors are not doing great and what sectors need to be improved on, but overall this was a good report for inflation. See, the Federal Reserve has been increasing rates at historic rates in order to combat inflation because inflation is getting out of hand and it is hurting the U.S. economy. So they're still expected to keep raising rates, and in their last meeting they indicated that they're going to continue raising rates into 2023. But they used this report to base the rate changes off of, and this was a good report. So people are wondering, are they going to keep increasing rates as far as they say they will, and the market, how it kind of reacted to this news? Because like most economists think, if we keep increasing rates, that's going to increase the chance for a recession. So the increased rates help the economy. But if it gets too bad, it's going to put us into a recession, and that's going to be much harder for all of the American people. But with this data, they might not need to put us into a recession. So there's new inflation figures that follow several signs that the U.S. economy activity cooled in the late 2022. And these include falling imports, exports, declining retail sales, manufacturer output, home sales, and slowing job and wage growth. Now, I know it doesn't sound like a good thing, but slowing the job and wage growth, like I've talked in the past, that's probably the most important one at this point because that's the only indicator that is still lagging behind the others. See, JP Morgan CEO Jamie Dimon suggests that the Fed will need to raise the rate to 6%. I think that's pretty high considering that all of the other Fed members are predicting between 5 and 5.25%. So a 6% inflation rate, that will surely probably put us into a recession. So I wouldn't expect that, but that is what one of the leading CEOs of America has kind of said. While this may be good news, it is still very high inflation, as it's pretty much record inflation as far as the past couple of years since the pandemic. And believe it or not, the U.S. isn't even in the worst spot, but the U.S. is getting hit pretty hard. See, in 2021, inflation was rising, people were spending, the government was just printing money, and our Jerome Powell, the head of the Federal Fund, or the Federal Reserve Bank, he said that inflation was transitory, and that was kind of a bunch of BS. A lot of economists didn't believe him, and for reasons so. I mean, you can't just spend tons of money and not expect inflation to go nuts. And so now we're dealing with that problem, and we're just seeing crazy high rate increases every year. But during the pandemic, we had super low interest rates and government stimulus out the pizzazz, and then we had the supply chain issues, also Russia and the Ukraine war that contributed to energy crisis in different parts of the country. In the world, and that really changed up the whole dynamic of how we get our energy, how Europe gets our energy, who's buying from who, and that if you just take out some of the supply, that's going to increase demand for what's remaining, and that also shoots the price up. So now the supply chain is easing, inflation is easing, but still some economists are worried because, like I said earlier, we're seeing all the categories fall except wage growth and wages. And we want wages to fall because what could happen is if people have still high wages but everything else is getting cheaper, they could start spending their money on goods, and then good companies are going to be like, oh, we need to increase our prices. And then you get the wage price spiral, and that is probably the worst case scenario that we could have during this time. So the Fed has been pretty clear that they're going to do whatever they can to get inflation back to 2%. But they said to not expect it in 2023 and probably not in 2024. It won't be until 2025 that we could see rates like that. In fact, they said they weren't even going to decrease the federal fund rate during 2023 at all. It could be a little bit of a bluff because they want those wages to come down, but that's where they stand at this point. And obviously the federal fund rate has a pretty clear impact on the housing market as mortgages are based off of that rate. And so the higher the rate, the less people get mortgages, the less volume of home sales, usually meaning home sales tend to drop in value. And we've been seeing that as home sales have significantly dropped and the values of these houses have been significantly dropping up to 10% in some areas. So an important thing that I found from the CME group is they see a 75% chance of probability of a 0.25 rate increase. And 25% of investors saw a 0.5% rate increase. So basically at the next meeting, if we see a 0.25 rate increase, the market will have already priced that in, and that's what we expect. Now, if we see a 0.5 rate increase, so meaning the Fed comes out and Jerome Powell says everything's bad and it sucks, then they're like, we need to increase rates by 0.5%. Then I would expect the market to react accordingly and take a pretty big hit. So next Fed meeting, 0.25, we're probably staying the same. Rates cut, we're going up. And if rates are increased by 0.5%, probably see significant. When this news came out about the new CPI data, the market really didn't have too much of a response, and it even, I think, was positive on the day. It was pretty flat. Okay, there was not a big response because we were pricing in that data. It was expected to be at 6.5%, and the market and the report delivered at 6.5%. So we just pretty much stayed there. Okay, so heading over into the data that the CPI gave us. So this column, this is a chart that breaks down each category on how much effect it had on the whole 6.5%. So this column right here is going to show us out of 100% the weight of that category, okay? And then the column right here next to it is going to show us the percentage change from November to December. So food is disappointingly high, 0.3%, pretty bad. It's at this point, it's getting ridiculous how food prices are just keep increasing. I think we saw something at eggs at like 20% higher than ever recorded. So we really need to be working on food prices and getting that under control. Another relevant category here is going to be energy, and energy comprises of about this much percent. Energy comprises about 7.8%, down 4.5% from the month to month. That's good news also, but keep in mind that it's not super important because energy prices can fluctuate on its own and without the economy. So all the other items make up 78%, and they're up 0.3% from month to month, which is not a great sign. But those key categories that are really hurting are furniture. Furniture is hurting at 0.2%. So you take this number times 12, and that gives you your year-to-year inflation percentage. What other big categories are hurting us? Transportation looks pretty good, and this is because new and used car vehicles are falling quite rapidly. Repossessions are going up quite quickly. Medical commodities up a little bit, not a huge deal. Their services minus energy makes up 58%, and that was up 0.5. Again, not very good. Shelter was up quite a bit, but also shelter lags behind the market, and we were already seeing stuff falling off. And with rates increases, we can pretty much expect this number to fall. So that's not a huge deal. Medical care services, we don't want to see that increase. We want this to be a negative number for the most part. Transportation services is up 0.2%. This is not a great sign. we need to make sure this comes down, especially any services. Food and beverages also significantly higher than the rest of the categories, and that's along with food. Obviously, I don't know why I said that. That's just a little bit of information from the CPI report, but overall, pretty good report. Didn't change a whole lot as far as the market perspective. It's kind of what we expected, so we'll see what happens going forward.